Good morning, it's Jeffrey Cohen. How are you? I'm an investment advisor representative with U.S. Advanced Computing Infrastructures Incorporated. We're also known as Chicago Quantum. How are you? Hope you're having a great morning. It is Thursday, December 8th, and I'm going to make this a shorter video. We're going to talk about interest rates, how they're moving, my hypothesis on what's going on there, which is a little different than what other people might be thinking. We're going to look at stocks. We're going to look at bonds. We're going to look at the markets. and so interesting. I ran my model and I don't like what I'm seeing. I actually see some weird stuff. So it's a risk off day. I'm going to share with you risk off. So I wish someone would transcribe this stuff. It's always interesting. So let's start with interest rates. Get right into it. So the first thing I notice is the 1 month Treasury bill. So 1 month Treasury should be right around the Fed funds rate, right around the policy rate, which is around 3.75%. And actually, it's down. It's down to 3.61. So what this says to me is the Fed, people are actually, they're driving down interest rates, which means they don't want the money. That's weird to me. So short 1 month treasuries, right? If there's concern, if there's liquidity concerns, that number should pump up. That number hit 4% a week and a half ago. And now it's down to 3.6. So my guess is the Credit Suisses, the Blackstones of the world, there was some kind of a squeeze, there was some kind of a run, there was some kind of a financial issue. And that drove prices lower. So if we look at, I'm not going to give you anything real proprietary here. I'm just going to start real simple. Credit Suisse. So if we look at Credit Suisse, Credit Suisse First Boston, but the First Boston is silent. If we look right around the 28th, you see the stock was dropping. The stock was still 460. It hit roughly $3, and now it's just starting to come back. My guess is there was a boom, and you see it also with Blackstone. Somebody went boom boom, and there must have been just some liquidity crisis, right? So what happens is these guys lend to the hedge funds who have these enormous, highly leveraged trades, and they kind of take them under their wing. Also, the big high-frequency traders, big dollar traders, and they provide them effectively all the credit they need to make their trades for the day, which I think is great. I wish someone would give me $400 million of credit so I can make my trades. But what happens is when the trades unwind, when things go wrong, I'm starting to get phone calls, right? Things are going wrong. And so, need money. Need it now. Need it now. Need it overnight. And so, my guess is if I look at the Fed reverse repo rate, yeah, it popped up. I'm not saying she's a gold digger, but she ain't messing with no broke. They need money. And so if you look, they pumped a bunch of liquidity into this market from 2050 on December 1st. Let's go here. November 25th, so right around Thanksgiving, it was around 2 trillion, which plenty of money, I think, excess liquidity in the market so that it has to be pumped back to the Fed to earn that little bit of interest. And now you're at 2.15. So effectively, they pumped $100 billion back into the market, which, in the old days was a lot of money. Now it must just be shit, right? So they must have pumped $200 billion in, and $100 billion went right back to the repo window. Overnight repurchase agreement. So by the primary dealers. So my guess is some of that money went to basically rescue some hedge funds and some money managers. So that's cool. I don't mind. The Fed, that's their job, right? Lender of last resort, put the liquidity out there. I think it's cool. I do think that's going to mess with the rest of the market. And so let's talk about it. So we look at yesterday's bond information. By the way, we love FINRA. FINRA regulates us. So, I mean, it's self-regulated, but, it's a whole industry thing. So we love FINRA. I love the data they put out there. If we look at the agency debt, you can see highs equal lows, advancers better than decliners. I mean, interest rates looked great yesterday. This was like a hot market, like a good old days market can only go up kind of market. If you look at corporate bonds, almost 8,000 went up versus 2,000 going down. Highs versus lows about flat. So we're looking at like a solid market. Convertibles, which has an equity flavor to it, even. High yield did better. Did like 1.5 to 1 up to down. So we're looking at, I mean, I don't want to make it weird, but like this was a great market, like an exciting market where, wow, can't take it anymore, right? Everything should be going up through the roof. But I don't think that's the case. I think interest rates fluctuated. So let's talk a little bit. So when you see the 30-year bond at 131, that's high. Right? It was recently like 120, right? So it really recovered, like 8%. The 10-year has shot up from like 110 to 114, up 5%. The 5-year shot up from about 106 to 1.9, about 2.5%. You see that the longer the bond, the more duration it has, the more movement, right? Interest rates move a little. The longer the bond, the longer the duration, the longer you have to wait for your money, the more risk, the more sensitive to price changes. If you look at the 2-year, it went from like 102 to 103, so it's up like 1%. So you did well. If you were in like TLT, long bonds, you did great, right? And so here's the thing though. I think a lot of traders, personal opinion, not investment advice, please don't trade on this. I think a lot of people swapped out their fixed rate risk. I think a lot of people sold away that gain, that 8% gain in a 30-year bond. And it may not last anyway, but for right now, loving it, right? And so why would you drive down 30-year bond yields, which drives up 30-year bond prices? There's two reasons. One is it's a true flight to quality. Two is we're at an interest rate where pension funds and investments managers and insurance companies, they can live on 3.5% interest, especially if they believe the Fed is going to keep inflation down to 2%. If Powell did his job and really taught everyone, they're buying all the way into the end of the year. I'm okay with that. It kind of makes sense. Now, the 10-year is like the $100 bill. The 10-year is the get shit done, asset. It's the borrow against this asset. It's the gold standard of assets. No risk, 10-year, it's great. Look at those yields. So people just fled to quality here. And I don't know, maybe. But there's a couple ways to see it. One is it's a recession risk. It's a recession trade. Oh, we're going into a recession, therefore buy the long bond. Put your money in a long bond because the stocks are going to keep going down. I don't know. I think this is a weird interest rate thing. So we take a look at the 1-year Treasury bill, which, by the way, I talked about not long ago. When you're at 4.8%, which we were at 2 days ago, Tuesday, that's good enough. You could go risk off. You could put your money away for a year for 4.8% interest and almost keep up with inflation. You're actually feeling pretty good there. No issues. But then you look at the 1 month Treasury at 3.6. So people truly believe that the Fed is either lowering interest rates right now, and that's that 100, 200 or more. That's the 100 billion that we talked about that went into. It's the money I just showed you, the Fed stuff that it pumped right back through the economy, right back through the banks, right back to the reverse repo window, right? That's what's driving this 1 month Treasury. So what I don't know is this similar to 2018 when the hedge funds had this carry trade that started to get unwound, and the Fed had to come in as a lender of last resort and pump $400 billion worth of money in, and that was Powell. Could still be Powell. Could have the same damn thing, right? We had Credit Suisse First Boston going bankrupt, and so got to pump liquidity, and you had Blackstone in trouble, right? You probably had some of the other banks too. And so I'm thinking this is a bailout. This is a very expensive Fed bailout. And that's what you're looking at here. And that's why bonds are so much better. The Fed didn't want asset bubble, my opinion. The Fed doesn't want 4-to-1 corporate bonds going up. I mean, the Fed wants us to start paying down our debt and unraveling. But now that we have layoffs, I mean, even Pepsi's laying off, right? No one can afford their bond yields. So I think they are just taking down interest rates in the short term. They're pumping some liquidity in for year end. I have no idea why they're doing it. I don't have inside information. I don't know if it's Credit Suisse. I truly don't. But my intuition tells me we got something funky going on. Funky monkey here, right? And it's about a week old. So we look November 9, and the market just pumped higher. What the F is going on here, right? It just pumped higher and pumped really high here. It was up 11%. And it's coming back down because they're probably draining a little bit of that liquidity out. This is just a follow the money trade. I mean, look at that. Now, what's interesting now is that, yes, this is a 5-day chart. CQNS. Thank you, CQNS. Nice. I love this chart. You can see, right, yesterday, financial's not so good, down almost at 0.4. But you can see the market kind of tread water and then just collapsed. And you see that the Dow Jones Industrials did better than the S&P 500, but now the Russell and then the NASDAQ. So we're probably looking at rates swinging, which is then turning off the spigot to tech. I'm going to get to volume soon. The market opens in 19 minutes. What the hell am I doing here? Why am I talking to you people? You know why? Because I love you people. You're my listeners. I love you. I want you to learn. I want you to make a ton of money in the market. I want you to understand that we are managing money and that we want to help manage your money. So we study this stuff all the time just to understand what's going on. We look at the NASDAQ. Here's another little simplistic view of the market. 6 months ago, the NASDAQ was higher than it is today. But if you look, we're in a trading range. We're in a trading range from like 11,000 to 13,000, roughly speaking. And we keep popping up and down, up and down, up and down. And so that's fine. We look at the S&P 500. We're also in a trading range, about 3,700 to 4,100. And we're at 3,960. It's fine, right? We're right in that trading range. And what's happening is the asset price bubble isn't bursting. The Fed is being very careful, but it's not going up anymore. So it's flat. I'm okay with that. I'm also okay with that, right? Interest rates went up, but modest, right? Normalization. I talk about normalization a lot now. The Fed can't afford to just pop the bubble because then politically it's unstable. The Fed can't afford to have companies going bankrupt. The Fed does want to see inflation come down, but it still needs economic growth. And so what I'm hearing about are a lot of people getting fired, and that's going to start to roll through the job data. And we'll just see what happens, right? So the Fed's doing a pretty good job keeping things pretty flat. Pre-market, where are we? So I don't really like these charts. This isn't that helpful for me. Oh, one thing interesting, I saw some data out there about inflation starting to cool. So Mexican annual inflation cooled to 7.8%, but the core index is still a concern. That's interesting because our annual inflation is like 6%. And so when Mexico is running only 2 points higher than the US, it tells you maybe things are cooling off. I thought I saw something about Germany's inflation. Let me see if I can find that. Trading economics. German inflation starting to come down 10%. Now it's funny when German inflation is higher than Mexican inflation. Mexico must be benefiting a lot from that close relationship with the US. But holy cow. Who else matters? How about Japan? Let's see Japanese inflation. That's always kind of a funny thing because Japan runs a very tight monetary policy. Inflation rate is 3.7%, up from 3. That's interesting. So that says maybe not. Maybe inflation isn't subdued. So what else? Who else is a good inflation country? Come on, tell me. Who? Who do you want me to look at? I looked at it. Okay, who do you love? AMA. What else we got here? So if we're not looking at Japan, who are we looking at? China. China inflation. 2.7 from 2.8. 2.1 from 2.8. Oh, I believe it. China having low inflation because, let's be honest, they're shutting down their economy, and so I get it. They're shutting things down. This may actually be the government also being very tight with money because China, maybe it's just different. So I don't know. Inflation, I'm not getting this warm fuzzy that inflation is necessarily lower. What I'm getting a sense in the U.S. is there may be some recessionary winds, and that's a whole different thing. Now, just so you know, we are short Cullen Frost, and we are long Corbis, and you don't really care, but I'm just giving you full disclosure. Those are my two big personal holdings. Talked about the 30-year. We talked about Mexico. Oh, let's get to some of the data. Oh, and we can just take one last look at the futures. We're up about 0.6 on the S&P 500. These are always lagged a little bit. The Russell's up 0.6, and Nasdaq's up 0.6. The VIX is still pretty high at 22.7, but low generally. It's been down. It's been high as 30, which is interesting. We never had that crash. Crude oil's up. Energy's up a little. Looks like bonds are down from yesterday. I don't know. This isn't. There was some interesting news, though. I was looking for job news, right? Job losses, but not seeing much. Not seeing much right now today. Yesterday, I said job losses, but not today. I like to take a look at banks. I like to look at banks. I think that helps us understand the market. But before you look at banks, you look at the dollar. The dollar's dropped below 105. That's actually pretty interesting. The dollar's falling. That's usually good for stocks because it's the fund that holds long interest rate bonds. You remember those 20, 30-year bonds we looked at? It's up 2.32% yesterday. That's crazy. Mortgage-backed securities up. Banks were flat. If you look, these are your long bonds, your 30-year, your 10-year, your 5-year, your 2-year. And you see this morning, interest rates are higher, but they're not really that much higher. Now, the fact that interest rates are moving by 7 basis points, and I'm like, yeah, not moving so much higher. 7 basis points used to be a lifetime move. And now it's like, oh, it's just pre-market. 7 basis points for the 5 year, for the 10 year, right? I mean, these are big moves, right? Look at this. 13-week at 4.18. That was 4.25 not that long ago. So, big moves. If we look at pre-market on the stocks, because I like to look at that, I bet you're not going to see much. Not much, but here's what I wanted to show you. So, I started looking at the summary of these are highly priced banks, and this is volume across against the 3 month. So these are banks with a very high book value, market cap to book. So what do I mean by that? I mean, so if the whole bank tangibly is worth $1, and intangible, because you're adding like goodwill, they bought a bank years ago and they got a name brand and maybe they got a toaster club, so it's $1.50. So the bank says I'm worth $1.50. These stocks would be trading at $4, $3, $4, $5 for a bank that's worth $1.50 per share, let's say, book value. So I look, and this column is how many shares traded yesterday, and this column is how many shares traded on average over the past 3 months. And you see the volumes are universally lower. So that means yesterday, some of them are not much lower, but some are less than half. Some of these numbers are pretty small. Esquire Bank traded 12,500 shares. Okay, Zion was higher, but Zion may have some credit risk. And SIVB is the bank for private equity and venture cap. So SIVB, the bank for private equity and venture cap. So if you want a good sense of how private equity, venture cap, are we in like a quantum winter, an innovation winter, you look at SIVB. And what you're going to find with SIVB is that, wow, do they suck. Look at that. We're in a quantum winter. We're in an innovation winter. It's awful. If you're in venture cap, go call up Target. They may have some jobs. The Walmart greeter. Hey, how you doing? It's not bad. Probably make minimum wage, maybe a little bit more. But, you get to wear a little name tag. It's nice, So, I wouldn't want to be an SIVB. But look at that, up 4% yesterday. Because risk looked like it was on yesterday. But I have no idea why. This is completely strange to me. So let's get into what I wanted to show you. So the first thing I want to show you, so this is our down run. These are all the stocks that are money losers. So I decided to take a look at last day volume versus average. So this is just a straight calc. So GOS is trading 22 times, last year's average. So we'll do a descending. So if we look at who's hot, GOS, RXDX, which went up, Prometheus, Experian, Carvana, which is crashing, traded 11.25 times average volume. MongoDB, there's not a lot of names I even know here, right? But wow, big. But if you look overall, the average is 0.9904. So the average stock of company that lost money traded on average 99 and 4/100% of the volume of last year. So we're at normal trading volumes for money losers. Why are people there? Because my guess is that the average close prices are lower. They're shopping bargains. Let's take a look. The average is 80.5%. So your money losing stock on average is trading down 19.5% versus where it was on average for the year. So that means nice, big, fat decline on companies that lost money. If you look at the variance, which won't mean anything in isolation, but the variance on average is 0.11. That's a normalized variance by the square of the stock price. But the good news is it's a variance, it's a squared figure, it's normalized. So all these can be compared against each other. So if we do a descending, you see the highest variance. This is so interesting. You could have this. I'd be happy to give you the run, to run it for you, to sell it to you, to help you be a better trader. This is what I do for a living, so I'd like to do that for you. So Alekos, Variance, Kodiak Sciences, Carvana, Matterport. There's a name I haven't seen in a while. Redfin. These are the stocks of firm holdings that have just a tremendous variance. If the average is 0.11, this is 3.2, 1.5, 0.85. These top three stocks, Carvana, Kodiak, and Alekos, those must be an options trader's dream because they are just flying like crazy. But so on average, though, let's look at variance. Go back to Jeff, get back on point. 0.11. So now let's look at the same data, but for companies that make money. Jeffrey, what do you mean they make money? They make money. They have a positive net income over the past 12 months. Okay. So first thing I want to look at is volume. Where are we at with the volume, Jeff? We're at 87.5%, 87.45%. So that means the volume of these stocks is lower. And that kind of makes sense. These stocks have less volume because people aren't really trading the money makers. They're just kind of letting them ride. So that's interesting. The most volume, let's do the sort thing. The ones with the highest volume, User Testing, Lovesac, Ollie's Bargain Outlet. Who are these companies? These are trading at like 4 times average volume. SJW, Progeny, Clearfield, Welltower, United Natural Foods. Now that's interesting. That's a local company to us. That's trading at 400% of average volume. Smith & Wesson, which may be going bankrupt, I read. Campbell Soup, M&T Bank, SVB Financial. Remember the bank for private equity. The Hackett Group. That's so interesting. So these are stocks that are trading massive volume yesterday. God, I should just look at this and trade these stocks because these are the ones moving. But okay, so let's look what else. Average closing price versus the average is 96.7%. Remember, money-losing stocks, down 19.5%. Money-making stocks, companies that make money, their stocks, they're down 3.3% against the average for the year. That's not much. Wow. When we're in a tough market, buy companies that are profitable. All right. Now let's look at variance. Remember it was 0.11. The average here is 0.0275, or roughly a quarter of the variance. So I want to leave you with the thought here. Money-making stocks, 1/4 the variance. 1/7 the loss. Lower volume. Lower volume by about 1/8. That's interesting. You could divide the market by profitable, unprofitable, and make very different trading models. By the way, we do that. We love that. So I thought that was interesting to share with you. The other thing I want to share with you, market's opening in 2 minutes. All right. That's it. Hope you enjoyed the video. By the way, these are our runs. $750. And you get all the data inside, which is basically the stock picks for the market for the day. Check out the website. I'll do something today. I'm going to be posting the results of our fund. And once I finish it, it takes a lot of work. It's a lot of detailed analysis. So if you found value, if you liked it, hit the subscribe button. Share the link. We like that. If you see it on Twitter, just retweet. I love it. And hopefully you make money today in the markets. Just the thing to really be careful about today is that interest rates have fallen very fast. And I believe that liquidity has been pumped into the market by the Fed very fast. And I don't know why, but I think it's a bailout. And it's funny that we don't hear about it. So FOMC is going to be talking. I think they're all very nervous. I have no idea what to expect. And just do okay out there. Good luck. Don't trade more than you can afford to lose. You take care now. Bye-bye.